Wealth tax is a tax levied on the market value of a taxpayer's assets. Some industrialized countries opt to tax wealth, but the United States has traditionally depended on yearly income taxation to collect money. During the COVID-19 epidemic, the federal government injected money into the economy to avert a protracted and devastating collapse, adding trillions of dollars to the national debt. National lawmakers are now proposing investing trillions of dollars more to solve physical and social infrastructure challenges. One country is proposing a new wealth tax on the evil rich to essentially fund a new universal basic income program. I'm going to tell you about the details and why you need to be aware of this, so be sure to stay till the end. Hello, and welcome to Stealth Wealth. Let's get started. Individuals' wealth is subject to a wealth tax, often known as a capital tax or an equity tax. The tax is normally levied on a person's net worth, which is defined as assets minus liability. Cash, bank accounts, shares, fixed assets, personal automobiles, real estate, pension plans, money funds, owner-occupied dwellings, and trusts are examples of these assets. On one hand, it's similar to the property taxes people pay on their homes, but it applies to all of their wealth above a certain level. A wealth tax is an ad valorem tax on real estate and an intangible tax on financial assets. In general, nations that charge wealth taxes also levy income and other taxes. Both the federal and state governments in the United States do not levy wealth taxes. The United States instead levies yearly property and income taxes. Since the government levies a yearly tax on the same item, some people view property taxes as a type of wealth tax. The United States also levies an inheritance tax on people who pass away with large estates. However, during the last several years, the levy's contribution to overall tax receipts in the US was just about 0.5%. A person's total net worth is typically the basis for a wealth tax. Your net worth would be $500,000, for instance, if you had $1 million in assets and $500,000 in debt. For example, a wealth tax of 1% would cost you 1% of your overall net worth. As your wealth increases, your debt would also decrease. Similar to property taxes, where you pay the tax yearly depending on the market value of your home, a wealth tax would be assessed yearly too. The distinction is that wealth tax would be levied on all assets, and this includes real estate, cash, investments, company ownership, and other possessions. A wealth tax has an effect on the net worth of the assets that a taxpayer owns as of the end of each tax year and has amassed over time. A taxpayer's realization of value adds, whether in the form of earnings, investment returns like interest, dividends, or rent, and/or profits from the sale of assets over the year, are all impacted by income taxes. Let's examine a case to illustrate how the wealth tax is different from the income tax. Let's say a single taxpayer makes $120,000 a year and is subject to a 24% tax rate. The person's annual obligation is 24% times $120,000, or $28,800. So what's the tax obligation if wealth is taxed rather than income? If the assessed net worth of a person is $450,000 and the wealth tax is 24%, the annual tax burden will be $108,000. In actuality, rates on yearly wealth taxes are far lower than those on annual income taxes. Some are proposing additional federal levies to avoid placing all of this extra expenditure on the national budget. A national wealth tax is one possibility. So, what distinguishes a wealth tax from the current federal income tax? To use economic jargon, income is a flow, but wealth is a stock. Income is defined as earnings during a specific time period, generally a year. Individuals' income is the sum of their earnings from labor and investment payments. A company's income is mostly sales proceeds. In a nutshell, income is defined as what flows to a person or corporation. Wealth, on the other hand, is the worth of investments on a certain date after deducting debt. Savings accounts, stock and bond holdings, real estate ownership, and anything else with monetary value are all covered. Evaluating wealth, like taking inventory at the furniture business where I worked as a kid, entails taking stock of your investments on a specified day. Wealth has considerably higher worth than yearly income. A wealth tax is thus being discussed in part because it's a very substantial and mostly untapped source of financial worth. Inequality is another reason why some people support a wealth tax. Compared to income, wealth is disproportionately concentrated among households with higher incomes. A wealth tax would achieve the objective of those who want higher income families to pay a bigger percentage of taxes than other households. Wealth taxes already exist throughout the nation, mostly at the local level. Cities and counties frequently impose property taxes on homeowners and business owners. Property tax income represents the greatest single source of public spending for many local governments. How does a wealth tax function? Conceptually, putting in place a wealth tax would be simple. A person's wealth value would be calculated once a year. The amount of tax would be determined by applying a tax rate to that wealth. Whether or not transactions occurred, the government would levy a wealth tax. 3 nations now impose a wealth tax: France, Portugal, and Spain. Most of them have progressive taxation, which means that the more money a person has, the higher the tax rate. In France, the wealth tax begins at 0.5% on an individual's net worth at 0.3 million euros and rises to 1.5% at 10 million euros. How the government structures the wealth tax will determine when someone owes it. So it might happen once a year or once in a lifetime. For instance, in order to pay for their involvement in the First and Second World Wars, various European nations levied one-time wealth taxes. When it comes to the different asset classes, a wealth tax doesn't have to be arbitrary. To encourage particular behaviors, a government may opt to exclude specific asset classes. To promote entrepreneurship, it can determine, for instance, that business assets don't count. The form of a wealth tax ultimately depends on how a nation drafts its legislation. Although a wealth tax seems uncomplicated, it has a lot of problems and unanswered concerns. There are precise metrics for several sorts of wealth, including stocks, bonds, and bank savings accounts, but not all of them. Homes and real estate often fall under this category. If your house hasn't recently sold, the value is merely an estimate. Official estimates are produced by local government departments. However, they're often not done annually. So, a method would need to be created to determine yearly valuations for properties. Access to all money could also be problematic. Many Americans have financial interests abroad. To improve asset reporting, the IRS would need to create procedures and standards. Wealth taxes are advocated because they're seen to be more equitable than an income tax alone, especially in nations where there's a large wealth gap. They contend that by taking into consideration taxpayers' total economic situation and consequently their capacity to pay tax, a system that generates government revenue from both the income and the net assets of taxpayers promotes justice and equality. Money taxes, according to its detractors, prevent people from accumulating wealth, which is what they believe fuels economic expansion. They also underline how challenging it is to enforce wealth taxes. A wealth tax poses challenges in its administration and enforcement that are not typically associated with income taxes. Valuation disputes arise between taxpayers and tax authorities as a result of the difficulty in determining their fair market value of assets for which there are no publicly available prices. Some wealthy people may be tempted to try tax evasion if there's uncertainty about valuation. Illiquid assets are a problem for wealth tax as well. Significantly illiquid asset owners might not have access to easy cash to cover their wealth tax bill. This is a challenge for those who possess high-value illiquid assets like households that have low income and little liquid resources. Similar to this, a farmer who makes little money but owns land that's worth a lot of money would find it difficult to pay a wealth tax. Some adjustments, such as enabling tax payments to be stretched out over several years or adopting a special treatment for certain asset categories including company assets, may be possible to solve administrative and cash flow difficulties. The goal of wealth tax, which many people believe to be to structure the total tax system so that every taxpayer pays their fair part, might be undermined by exceptions though. The wealth tax's supporters see it as a method to increase public expenditure by removing more money from individuals who don't truly need it. It might be claimed that because such a tax mostly affects the richest people, it'll have little effect on their standard of living. A wealth tax, on the other hand, it's difficult to manage. It encourages tax fraud and has the potential to push the affluent away from governments that impose it. These drawbacks, together with arguments about how to execute it properly, may explain why relatively few governments impose such a tax on their population. Wealth tax polls result favorably, even among Republicans. A survey conducted by the New York Times and SurveyMonkey in July of 2019 indicated that 2/3 of all Americans, including 55% of Republicans, supported a 2% wealth tax on anybody with more than $50 million in assets. Opinions differ on how the individuals who pay the tax would feel. On one hand, 20 members of the top 0.1% wrote an open letter in June pushing for a modest wealth tax. However, there are other rich Americans who aren't as enthusiastic about this form of tax. Wealth may be significantly more erratic than other economic indicators, such as income and spending, which poses a practical difficulty. Think about the stock market's significant ups and downs in 2020, when the epidemic was at its worst. Forecasting wealth-based tax receipts was made more difficult by this. Then there's the contentious issue of who should be subject to a wealth tax. Should everyone who has money pay the tax, just like the local governments tax homes? Or should only those with wealth over a particular amount of income contribute? In fact, the majority of the current wealth tax plans would only impose the tax on the extremely wealthy. Should a wealth tax instead be designed similarly to the income tax, with lower tax rates for households with lesser incomes and deductions that lessen the amount of a person's wealth that is subject to the tax? Some experts are also concerned about how wealth tax may affect the overall economy. Would the tax deter people from saving and investing, which are essential for obtaining the money needed to build houses, launch businesses, and support new innovations? If the answer is yes, a wealth tax may impede the rise in our society's quality of living and hinder economic expansion. In the upcoming weeks and months, I believe we'll hear more talk of a wealth tax, particularly at the federal level. Consider the specifics of any wealth tax before deciding whether you support it or oppose it, as you should with other critical decisions. So that's it for our video about wealth tax. Please do me a favor and like and subscribe to this channel. Also, watch our other related videos.